Hello and welcome back. If you like chapter 1 to 3, oh boy, do I have a treat for you. Chapter 4. Chapter 4 covers wrapping up the accounting transaction process, and we'll be discussing adjusting entries and preparing the financial statements. The one good thing and bad thing, depending on your perspective about this course, is that we keep building on the same foundation that we started with. So at this point, we already learned about the fundamental accounting equations for the balance sheet, income statement, statement of shareholders' equity, and cash flow statement. We've already learned about the accounting equation needing to balance and figuring out what accounts go up or down. And then I've already provided you with the conversion guide to convert everything to debits and credits. So the good news is, if you understood any of that, then what we're going to go over in Chapter 4 is going to be relatively easy to understand. It does take it up a notch in some ways, but you really can't start Chapter 4 without at least having those fundamentals under your belt. So if you need to, you may want to go back and review the rules of debits and credits and how the accounting equation must always balance with each transaction before moving into this chapter. If you have a good solid foundation, then this chapter should be just adding to that foundation. So the first thing to mention is that management is responsible for preparing the financial statements. And when they prepare them, remember the overall goal is to provide useful information for decision makers. And in order for it to be useful, it needs to be of high quality, which means it needs to be relevant to the decisions at hand, and it needs to be truthful, which is what we call in accounting faithful representation. That's the only way it's going to be useful to the investors and creditors as well as the other users of the financials. So the first thing we're going to go over is adjusting entries. Now, I will caution you that though I don't believe adjusting entries are that challenging, if you approach them with the right perspective, which means thinking things through, using logic, not just memorize and regurgitate, you'll do just fine. But students tend to struggle with this. So you're going to want to spend a lot of time reviewing and practicing adjusting entries, because more likely than not, that is the topic that'll give you the most trouble on our first exam. I don't want that to happen for you, so I've given you plenty of resources on adjusting entries. I've given you an adjusting entry summary that you'll find in the chapter module, as well as the summary that I'm going to go over in these slides and the examples that we'll go over as we move through the lecture. Practice makes perfect, so use those practice resources that are available on both Canvas and Connect. And the more practice you get, the more confident you'll be with this material. And as always, if you are struggling, reach out on the discussion boards or reach out to me and we can set up a Zoom meeting for office hours. So you may remember in Chapter 2 and 3, we went through the process of analyzing, recording, and posting transactions. I called it analyze, journalize, for recording, and post. So analyzing is really the hard part. That's when we figure out the ups and the downs, which accounts are affected and do they go up or down. And then we can make sure and verify that A still equals L plus E when we're done. After that, we use our conversion guide to journalize or record debits and credits that reflect the up or the down of the transaction. And then finally, we shove it into a T account, which is the posting. In Chapter 4, we're going to talk about how we prepare trial balances, which we've already really talked about in previous chapters, which is to verify that debits equal credits. And then most importantly in this chapter, we're going to cover adjusting revenues and expenses at the end of the period, because remember, revenues are recorded when earned, expenses when used, not necessarily when cash changes hands. So at the end of the period, it's going to take a little thinking on our end to ask ourselves, did we earn any revenue that we haven't maybe recorded yet because we didn't get the money? Did we use any expenses that we haven't recorded yet because we haven't paid it? Or maybe we paid some of the expenses in the past, but now we've used it up, or we've received some revenue in the past, but now we've earned it. So we're going to have to figure out how to make those adjustments and fix the balances that'll show up on our financials. And then we're also going to answer the question that I know you've been dying to hear the answer to, which is how do we get that net income into the equity and retained earnings balance. So you may remember this beauty right here: assets equal liabilities plus equity, revenue minus expense equals net income. And in chapter 3, and even before that, I kept drawing this arrow from net income into equity, because whatever happens to our net income is going to happen to the retained earnings part of our equity. So the closing process is going to tell us how we actually make that arrow happen on the financial statements and books of the company. So what are the purposes of adjustments? Well, I've already alluded to this, but to go over it in more detail, revenues are recorded when earned according to the revenue recognition principle, and expenses are recorded when used, which is what the expense recognition or matching principle states. Assets are reported at amounts that represent future benefits. Liability are future detriments or sacrifices of assets and services. So companies wait till the end of the accounting period to adjust their accounts, because doing so daily or weekly would be very costly and time-consuming. Adjusting entries are required because every time a company prepares financial statements, they need to make sure that the numbers at the end of that period of time, or for that period of time, are accurate and correct. Remember, the transactions for a business happen over a period of infinity, and then when we create financials, we chop up infinity into small, manageable, bite-sized pieces, like months, quarters, or years. So we need to make sure that the financials reflect everything that's happened within that month, that quarter, or that year. So there's 4 types of adjusting entries. There are deferrals and accruals, so that's 2 overall categories. And then within those overall categories of deferral and accrual, we have deferred revenues, deferred expenses, accrued revenues, accrued expenses. With deferrals, cash comes before year-end and the adjusting entry. With accruals, cash comes after. And then I remember the difference between the two, because after and accrual both start with the letter A. So the accrual is the one with cash after, deferrals are cash before. And that's what these pictures over here are trying to show you. So with our deferrals, you can see there's the entry for the receipt of the cash and then the adjusting entry. So the cash is before the black line, which is the end of the year. You see that with deferred expenses as well. So cash before adjustment means we're a deferral. Cash after the black line, cash after the adjustment, is an accrual. So what are the steps? Well, this slide makes it look really complicated. Here's my step. Think. Use your brain, think through logically, and you'll come to the right conclusion. If you need a little more framework than that, step 1 is to ask yourself, was a revenue earned or expense incurred that's not yet recorded? If yes, ding, 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 we need an adjusting entry. Step 2 is, was the related cash received or paid in the past, or will it be paid in the future? That's basically distinguishing between whether we're dealing with a deferral or an accrual. So if cash was received in the past or paid in the past, that's these 2 options. Then cash came before, so we're dealing with deferrals. If instead cash will be received in the future or will be paid in the future, then we're dealing with our accruals, cash after accrual. Then the step 3 is to compute the amount of revenue earned or expense incurred, and then record the adjustment. There's only 4 types, so there's a million problems we can give you, but there's really going to always be 4 answers, and these are the 4 answers that will result. What you see on this slide are the 4 generic adjusting entries that could be used throughout this entire chapter for every type of problem. When we have a deferred revenue, it means we got the money before we earned it. So the account that's involved with that is an unearned revenue. Because when you get money before, like that airplane example I've given in previous lectures, the airline gets your money, they don't earn it till they fly you, so they have a liability, they owe you a flight. Then when they earn it, what the adjustment is going to do is remove the liability and record the revenue. With a deferred expense, again, you paid something before, you used it, so that created a prepaid. So as a passenger, you prepay your flight, and then when you fly, you're using it up. Remember, revenues are simply a record of what's been earned over time. Expenses are a record of what's been used over time. So when we earn the revenue, the amount we owe, the flights we owe, go away, so the liability goes down. When we use the expense, that prepaid asset would go away. That should make logical sense. And if it doesn't yet, don't fret. It will, hopefully, by the end of all of the lectures for this chapter. With accrued revenue, it means cash comes after. So we earned something. I provide you a good or service, so I earned it, revenue. And then I haven't received the money yet, so boom, receivable asset goes up. That should make logical sense. I've earned it. That means revenue. I haven't received it, so I have a receivable. With an accrued expense, I use something, use expense, but I haven't paid it, so I owe it. I have a payable. I've used it, expense. I haven't paid it, I have a payable. So in your brain, as you're going through this, first determine if you have a revenue or expense. If you have a revenue, you're always going to credit revenue to make it go up. If you have an expense, you always debit the expense to make it go up. Because whenever we're dealing with adjustments, revenues and expenses are always going up because we've either earned the revenue or used the expense. As far as what the other account is, logic is your friend. If I previously had an unearned revenue and now I'm earning it, that unearned revenue goes away. If I previously prepaid an expense, now I'm using it, the prepaid goes away. If I've earned revenue and I haven't received it, I have a receivable. And if I've used an expense and I haven't paid it, I have a payable. Trust the logic, my friends. Embrace it. Don't memorize, regurgitate. Even though you have these examples right in front of you during the exam, not understanding it is not going to serve you well on the exam. You need to understand the logic behind it. It's going to make it so much easier for you. So before we go through some example problems, I think it's useful to give you a summary, similar to the one that's provided by the textbook, but I like to give you the full picture. So I want you to see the entry for the cash before or after the adjustment. So I highly recommend you take notes on this. So start by creating 4 quadrants. And we know there's 2 types of adjustments, deferrals and accruals. And then those are further broken up into revenue and expense. So all in all, we'll end up with 4 different adjusting entries, but there's really 2 overall categories, deferrals and accruals. With deferrals, cash comes before the adjustment. So we'll get exciting here, and I'll color code with green for money. So we're going to have cash first. So with a deferred revenue, we get the cash before we earn it. So the original entry done during the year would be to debit cash, because that's how you make assets go up, and then credit that unearned revenue we've talked about, because you got the money, but you haven't earned it, so liabilities would go up. Again, this is the example of the airline getting your money, but they haven't provided the good or service yet, so they haven't earned it. Then we have the adjustment, which would come after. So with the adjustment, change to purple. The adjustment's what happens at the end of the year. So at the end of the year, we would determine that we've now earned some of the revenue, so we provided the flight. So if we earn the revenue, revenue's going to go up with a credit. And if we've earned it, we don't owe it anymore, so our unearned revenue liability would go away with the debit. On the deferred expense side, first we pay for an expense before we use it. So that would be like the passenger prepaying for their airline ticket or you prepaying your tuition. So when that happens, we have a future benefit. We get a future flight or future education that we haven't used up. So that's what we call in accounting a prepaid expense, which is an asset. It goes up with debits. And then cash, another asset, will go down with a credit because we paid for it. At the end of the year, we've now used up part of it. So we took our flight, or you've had your education. So the adjusting entry for the passenger or the student is going to be to record the expense because we've used it. So expenses go up with debits. And what have we used? We've used up our prepaid asset. So our prepaid expense is going to go down. And to make assets go down, we credit them. That should make some logical sense. Notice the green comes before the purple because with deferrals, cash is before. Let's move on to accruals. So I'm going to change, well, actually I don't need to change my color. I'm on purple. And with accruals, the adjustment is going to happen first. So with an accrued revenue, we earn the revenue, but we haven't received the money yet. So if we earn the revenue, we credit revenue to make it go up, just like in our deferred adjustment. What's different is the debit. I've earned the revenue, but I haven't received it yet. So I provided the good or service, but I haven't received the money. So I have what we call in accounting an account receivable. So account receivable, an asset will go up, and assets go up with debits. Then what happens is cash comes after with an accrual. So the cash entry would be what happens when we receive the money. So when we receive the money, our cash asset goes up, and then our receivable goes away. A lot of times students get confused here, and they want to have the receipt of cash equal revenue, and it doesn't. You earn the revenue by providing the good or service. You did that at the time of the adjustment, so when you get the money, you can't double dip. You can't record revenue again. So all that's happening is you're getting cash in exchange for that receivable. So one asset go up, one asset go down. By the way, if you were wondering, those X's that I'm writing just represent the numbers you would put into the journal entry. Let's move on to the final category, accrued expenses. With accrued expenses, it means I've used up an expense, but I haven't paid for it. So like with your utilities, you use up the electric, and then you get billed. So when you use it up, you've incurred an expense, so expenses go up with a debit, and then you haven't paid it yet, so you owe the money, and that would be a payable liability, which goes up with credits. Again, don't memorize debits and credits. Think up and down, and then use your conversion guide to figure out if it's a debit or a credit. Then what happens? Well, then you pay for it. So the cash entry is going to be debit the payable, because if you pay for it, you don't owe it anymore, so your liability goes away. And finally, credit cash, because how do you pay for things? With money, and credits to cash make assets go down. So with all of these, debits have to equal credits, ASD equal L plus E, so keep that in mind. And then some commonalities that I want to show you between the entries to make this a little easier. Pick another color here. Is that when we have adjustments for revenue, no matter if it's a deferral or accrual, we always have a credit to revenue. And then what's the debit? Well, we use a little common sense to think it through. If we've previously have an unearned revenue, then unearned revenue is our debit. If we haven't received the money, then receivable is our debit. With expenses, both adjustments have a debit to the expense, so the question just becomes, what's the credit? If we previously prepaid it, the credit is to our prepaid asset to make it go away. If we haven't paid it yet, our credit would be our payable because we owe the money. Also remember, with deferrals, the cash comes before. With accruals, the cash comes after. Before or after what? Before or after the adjusting entry that always occurs at the end of the period. I hope that this is helpful, and I highly recommend that you write it down if you haven't already and utilize it throughout the remainder of the lectures, because you'll see that every example we go through falls into one of these four quadrants.